Wall Street is quietly panicking, and most investors have no idea why. Japan's debt system just cracked, and the solution they use could be the exact playbook the United States follows next. Right now, Japan is sitting on nearly $1 trillion in hidden losses, and instead of admitting the damage, the rules were changed overnight to make the losses disappear on paper. But this isn't just Japan's problem. If you invest in stocks, ETFs, retirement accounts, gold, or silver, this could impact your portfolio faster than you think. And by the end of this video, you'll understand why Japan's crisis is a warning for the US, how inflation could quietly destroy wealth, which assets historically survive debt crises, and one simple indicator you can watch to track the risk yourself. This isn't a doom video. This is about understanding what's coming and positioning ahead of it. Japan's financial system is under enormous pressure. Japanese banks and insurers are holding massive amounts of government bonds, and those bonds have collapsed in value. Some bonds originally issued near 100 yen are now trading near 38 yen. That means losses of more than 60%. Why did this happen? Because these bonds pay extremely low interest. When interest rates rise, old low-yield bonds become far less attractive, and their market value falls. This is the exact same mechanism that caused the 2023 banking crisis when bond losses destroyed major financial institutions. Except Japan's situation is far bigger. Instead of allowing banks to recognize those losses, Japan made an emergency decision. Accounting rules were changed so financial institutions no longer have to report the losses. In simple terms, even if a bond lost 60% of its value, banks can still pretend it's worth full price. On paper, everything looks fine. In reality, while the losses still exist, Japan's problems don't stay in Japan. For decades, global markets have depended on something called the carry trade. Investors borrow money cheaply in Japan, then invest that money into higher return assets like US stocks, US bonds, real estate technology companies. This trade is enormous. Estimates suggest it could exceed $20 trillion globally. But when Japanese interest rates rise, that trade begins to unwind. Investors pull money back to Japan. And when that happens, markets fall fast. We've already seen a preview. When Japan slightly tightened policy before, Bitcoin fell sharply, US tech stocks dropped, major indexes sold off quickly. Not because of earnings, not because of news, because liquidity moved. Japan is not unique. The United States faces the same structural problem. Government debt has grown faster than the economy. Deficits continue expanding. And eventually, every country with excessive debt faces the same three choices. Politically impossible. No major economy wants to admit failure. Cut spending and raise taxes. Also politically impossible. Print money. Devalue the currency. Pay debts back with cheaper dollars. Historically, this is the path governments choose. Japan is already following it. The US may follow next. Most investors think they are diversified. But many portfolios are exposed to the same risks. Cash loses value during inflation. Bonds lose value when interest rates rise. Dividend yields struggle to keep up with inflation. And retirement portfolios often hold all three. That means inflation becomes a silent tax. You don't notice it immediately, but over time, purchasing power erodes, savings shrink, and real wealth declines. Not because of bad investing, but because the currency weakens. Debt crises always create winners and losers. Historically, the winners are those who own real assets. Assets that rise with inflation. Assets that cannot be printed. Two categories tend to stand out. Companies with pricing power, businesses that can raise prices without losing customers, strong margins, low debt, high cash flow, essential products. These companies often survive inflation better than the average stock. Precious metals have protected wealth for thousands of years. Gold and silver cannot be printed. And when confidence in paper currencies declines, investors often move toward physical assets. Historically, gold performed strongly during inflationary periods. Silver tends to move with gold, but with larger swings. More volatility, but potentially greater upside. Some assets struggle badly during inflationary cycles. These include large cash positions, long-term government bonds, high-yield dividend plays, rate-sensitive sectors, and speculative companies dependent on cheap money. These assets often perform well during stable periods, but struggle when debt and inflation accelerate. The situation won't unfold overnight, but there are signals investors can watch. Key indicators include Japanese bond yields, currency movements, market volatility, liquidity shifts. When these begin moving together, risk increases, and when conditions stabilize, the threat fades. Tracking these signals helps investors make decisions based on data, not fear. Japan may be showing the future. Debt levels continue rising worldwide. Governments will try to avoid collapse. And history suggests inflation becomes the solution. The question is simple. Will investors be prepared or surprised? Because in every monetary shift, some people lose wealth and others protect it. The difference is understanding what's happening early and positioning before the crowd.